SGX has just launched the IH Singapore Next 50 Indices. These benchmarks were created to track the performance of the next 50 stocks, sitting just outside the familiar 30 companies in the Straits Times Index. But here's the real question. Are these new indices actually worth paying attention to? In this video, I'll walk you through what the indices are about, take a closer look at their key holdings, compare how they have performed against the STI, and finally share my thoughts on them. So basically, the IH Singapore Next 50 Indices was designed to shine a spotlight on mid-cap companies that don't quite make the cut for the STI, but are still large, liquid, and important players in the Singapore's market. In other words, while the STI is made up of the 30 blue chips, the Next 50 represents the next in line. These are the firms that might one day graduate into the STI, or at the very least, give investors more ways to diversify beyond the usual big names like DBS, Singtel, and CapitaLand. Now, there are two versions of the index, with the first one that is weighted by market capitalization and the other by liquidity. Both indices will have the same holdings, but with some differences in the weightage. So, how are the companies selected for the IH Singapore Next 50? Here's how it works. SGX begins with all the stocks listed on the SGX main board. From there, the 30 largest company by market cap, aka the STI constituents, are excluded. That leaves us the rest of the market. But of course, SGX won't just put everything in there lah. There are a few extra checks to make sure only the more investable names get through. So first, every company must have a minimum free float of 15%. This ensures that there are enough shares in public hands for proper trading. Second, each company must have a market capitalization of at least 100 million SGD. So we exclude penny stocks or tiny illiquid counters. Third, there are liquidity requirements. Companies must maintain at least $100,000 in median daily trading turnover, while also meeting minimum trading velocity thresholds. This is to ensure that the stock is traded actively, so investors can buy or sell without facing too much difficulty. Once these filters are applied, the largest 50 companies by market cap are chosen. To keep things balanced, as all things should be, no single stocks can take up more than 5% of the index. And this is what you get. The first thing you will notice is that the indices are quite REIT heavy. Out of the 50 holdings, 16 are REITs, and together they make up about 44% of the Next 50 index and 34% of the liquidity weighted index. Some of the biggest names here include CapitaLand Ascott Trust, Capel REIT, Suntec REIT, and Parkway Life REIT, each maxed out at the 5% cap. Even NTD-DC REIT, which was just listed recently, is here too. This can be a good or bad thing depending on how you see it. On one hand, REITs tend to be more stable, and with interest rates expected to trend lower, the sector could enjoy a boost in the coming years. On the other hand, however, having such a heavy REIT weightage would make the index more sensitive to property cycles and interest rates movements, similar to the STI, which also has a big exposure to REITs. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Beyond the REITs, the index also has about 13% in industrials. This includes names like ComfortDelGro, Singapore Post, SIA Engineering, and SBS Transit. Now, while ComfortDelGro and SingPost has faced challenges in recent years, the good news is that both companies are actively trying to pivot their businesses. On top of that, they still carry relatively strong balance sheets, which gives them the financial flexibility to weather downturns and invest in new opportunities. In other words, while they are not the stars they once were, they are far from write-offs. Meanwhile, SIA Engineering remains a key player in the aviation maintenance and retrofitting business, while SBS Transit continues to benefit from its essential role in Singapore's public transport system. Together, these industrial names bring a mix of stability and long-term relevance, even if their growth isn't as fast as the tech or healthcare names in the index. Next, the financial sector also makes up around 13% of the index. And yes, Singapore has more financial companies than just DBS, UOB, and OCBC. In the Next 50, you'll find firms like Jiang Financial, iFAST, and UOB Kay Hian. These companies bring additional diversity to the mix, whether it is debt management, digital wealth platforms, and brokerage services. Besides that, there are also other sectors in the index. For example, in consumer non-cyclicals, you have Sheng Siong, a resilient supermarket chain that is super stable even during downturns. In telecommunications, there's Netlink NBN Trust, which provides the backbone of Singapore's fibre broadband network. And in healthcare, the standout is Raffles Medical Group, aka one of Singapore's most established private healthcare providers. So as you can see, many of the holdings are familiar names, and while they may not be part of the STI, many of them are still strong and established companies, some even among the former top 30. With the IH Singapore Next 50, investors now have a passive and diversified way to gain exposure to this next tier of Singapore-listed companies without having to pick and choose individual stocks. But anggap bolas aside, how has the Next 50 actually performed compared to the STI? Over the past 10 years, the IH Singapore Next 50 Index has delivered an average return of about 5% a year. This falls short of the STI's stronger 8.9% per year. Meanwhile, the liquidity-weighted version did even worse, averaging at just 3.1% per year. However, with that being said, the STI hasn't always had the upper hand. Between 2015 and 2024, the STI only outperformed the Next 50 in 5 out of 10 years. In other words, they have actually taken turns outperforming each other. And more recently, the Next 50 has been on a solid run. In 2025 year-to-date, while the STI is up by 19.3%, the Next 50 has gained 24.6%, and the liquidity-weighted index has climbed 25%, both outperforming the STI. Likewise, there were also other periods when the Next 50 did better. For example, during the COVID-19 pandemic in 2020, glove makers, healthcare names, and logistic firms surged, which boosted the index. Similarly, during the shipping boom of 2021 and 2022, shipping and logistics stocks like Samudera Shipping and Costco Shipping drove strong outperformance. Or in other words, the Next 50 is best seen as a good complement to the STI. That's because while the STI tends to be defensive, dominated by banks, large REITs, and a few big industrials, the Next 50 leans more towards mid-cap names. These are companies that may not be household names yet, but they have room to expand, and in certain cycles, even outperform. And put together, they provide investors with a more balanced and complete picture of Singapore's equity market. Now, of course, since the IH Singapore Next 50 has only just been launched, there isn't any ETF or mutual fund tracking it yet. So if you want exposure today, you will either have to buy the individual stocks one by one, or wait for fund managers to roll out products that replicate the index. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe, as I'll be posting new videos every week.